Welcome to the Real Estate Show with Pat Lopez, where we talk everything real estate. For this show, we're going to be talking about interest rates. What is going on with these rates? It seems like these rates are never coming down. As soon as they come down a little bit, boom, they jump right back up. So if we look at 2024, the average interest rates, they ranged anywhere between 6.25% up to 7.5%. So you can look at this chart that I have right now, should be up on the screen, and you can see how the ebb and flow of these rates jumped up as high as the 7.5 and as low as the 6.25. Now, Mortgage News Daily. It's a site that surveys over 100 lenders throughout the country. And what they do is they look at, or they ask, what is a mortgage company's interest rate, and they put it all together and they come up with an average. So if we look at this week, which is right before Christmas, Merry Christmas to everybody, and Happy Holidays, Hanukkah, and whatever else you're into. Anyway, if you look at what the average interest rate is nationwide, it's a little bit over 7%, like 6.125. Now, there's some qualifying questions for that. One, 780 and above credit scores, putting 25% down, buying a single family owner occupied home. Okay, not an investment property, not a multifamily. So there's some qualifiers. So you're looking a little bit above 7%. So we're trading at closer to the highs than the lows throughout the years. Now, if we look once again at that chart that we had, it shows you that right after September 18th, when the Fed started their rate cuts, interest rates started spiking up. Now, most people turn around and think, what the heck's going on? That doesn't quite make sense. Didn't the Fed lower the rates? Well, we need to understand what the federal funds rate are, okay? They are short-term interest rates that the bank lends to other banks, okay? So it's a short-term loan that banks will lend to each other, and the Federal Reserve, they set what that interest rate is. So yes, they did lower the federal funds rate, but that impacts more the short-term, because this is a short-term loan, short-term loans, like a car payment, like credit cards, okay? These are short-term items, so they have much more impact on those, and commercial lending. Commercial lending also looks at the federal fund rate, and they are really controlled by that. But now, the 30-year fixed loan, which most people get a 30-year fixed, that is a mortgage-backed security or a mortgage bond, okay? And that is 30 years, a completely different animal, okay? We're not talking about short-term, long-term. Now, who controls the 30-year fixed bond rates? Well, they're investors. They could be pension funds. They could be investors buying a secured part of their portfolio. They'll turn around and they'll look at bonds. So the bond markets are control those interest rates. So what has happened with the interest rates on the 30-year bonds? Why did they go up? Well, there was a lot of news came out in the last 2 months. Inflation's numbers have been heating up a little bit. So no good, right? Second thing that came in was employment numbers, a little bit hotter than what the Fed wanted as well. Okay, and then the third thing is the Federal Reserve talked about 2025, how they're not going to be as aggressive and cut the federal fund rate. So they were going to cut 4 times. Now they're talking about cutting maybe 2 times. So the combination of inflation numbers coming in higher, employment numbers coming in higher, and then the Fed saying they're going to cut less, caused interest rates to go in the low 6s all the way up to the 7 1/8-ish type of rate, okay? So that is what's going on as far as that is concerned. Now, we can look at the chart that we have on the screen, and this shows you what for the lack of a better word, the smart people in the room, what they're predicting interest rates to be in 2025. So you have Goldman Sachs, you have Realtor.com, you have Bright, you have NAR, all these people are predicting, and the ranges are anywhere between, 5.9, as high as, 6.4. Now, Housing Wire, they're saying the range. They're looking at anywhere between 5.75 up to 7.25. So you could have, peaks and valleys, and that's what they're talking about as far as that's concerned. So you can look at that chart. You can see where their projections are for next year. Now, we know with higher interest rates, with home appreciation going up, because houses have been going up, they haven't been going down, and the demand out there, so lower inventory. So when you take all that in consideration, so you have demand, you have higher prices, and you have higher interest rates, it's causing a lot of people not to be able to jump in the market. Affordability is a major issue. Okay, so we also know when interest rates are in the low 6s to high 5s, you get a lot of people, buyers and sellers, you have a lot of people jump back into the market, okay? Because now the affordability becomes a little bit better, or they just feel better about, getting a lower interest rate. But once again, affordability. So what can we do now, today, to get into the high 5s, low 6s? Well, there's a couple of options out there for you. Option number one, there are bond programs. Okay, bond programs, state bond programs, things like that. Currently, they're in the 5s, some of those programs. Now, the issue with the bond programs are, generally you need to be a first-time home buyer, okay? So not everybody's going to fit within that. Plus, you may have income limits, you may have, asset limitations. But once again, first-time home buyers generally are those bond programs. Yes, they're a great option for many people. And if you don't know about the bond programs and being able to offer your clients the high 5 as far as interest rates are concerned, give me a call, Pat Lopez. This is, huge. It's something that we're doing a lot of, okay? Now, the second option you have are ARMs. Now, I know a lot of people are saying, what is an ARM? They don't understand an ARM. There's a lot of, negativity around ARMs. And that is true, because in 2006, 7, 8, ARMs were really no good. There were subprime ARMs, and the ARMs were set to have your interest rate jump up after 2 or 3 years dramatically. So you could have started at 6%, and then all of a sudden 2 years later, 3 years later, it jump up to 9%. And a lot of people just couldn't afford that, okay? Well, these ARMs today are a little bit different, okay? But let's first explain what an ARM is. There's basically 3 pieces to the ARM. One is the index, and the index is what fluctuates. And what we look at today generally is the SOFR ARM, okay? And that's the Secured Overnight Financing Rate, the SOFR ARM. And that moves up and down. It's the index. Okay, the second part is the margin. The margin is what the bank wants to make, okay? Their profit. So you can have a margin of 1%, 1.5%, 2%, whatever the case is, but that's a margin, and that's fixed. That's a constant, okay? That never changes. You sign your mortgage, your note, you're going to tell you, hey, this is what your margin is. The fluctuation is the index. And the third thing is, how long is the fixed period? Okay, and the most popular ones are 5-year, 7-year, and 10-year fixed period. So if you turn around and you get a 5-year ARM, and you have a margin of 1%, the SOFR index right now is at 4.6. You're looking at an interest rate right around 5.5 to 5.6% interest rate, okay? Dramatically better than the 7.125. So the question that I have, any person thinking about getting an ARM is, do you believe interest rates are going to go down in the next couple of years? If the answer is yes, an ARM is a possibility for you. It could be a good option. If you say no, I believe interest rates are only going to go up, don't even think about an ARM. Makes no sense, because the whole purpose of an ARM is to turn around and save $400, $500, $600 a month by having that lower monthly payment. And then in turn, 2 years, 3 years, 4 years down the road, 5 years down the road, you're going to refinance out. So once interest rates drop in the 5s, you're going to refinance out of that ARM. And then you have your forever loan. Now you may turn around and say, but hold on, now I have to refinance. Well, the refinance is baked in the cake no matter what. Because if you have a 30-year fixed loan and your interest rate is 7 1/8, 7.125, and somebody calls you up and say, listen, I can save you $500 a month. I can give you an interest rate on a 30-year fix for 5.5. You're going to refinance. So why pay a premium for that 30-year fix when you're not going to keep that 30-year fixed loan? Also, understand, that's only if you believe interest rates are going to go down over time. We don't know if they are or not. Nobody has that crystal ball. But that would be a calculated risk you would make at your comfort level of believing that interest rates are going to come down. They're not going to stay this high. Okay? So that's what an ARM is. Remember, it's fixed for 5 years, 7 years, 10 years, no prepayment penalties, so you can always refinance, no penalties. And typically, you're going to save a ton of money with $500, $600, $700 a month that you will save because you have that lower interest rate. So a viable option and something to consider. So once again, how do I get into the fives? Well, heck, I can do a bond program if I'm a first-time home buyer, if you qualify. I can do an ARM program. And a lot of the builders are doing ARM programs for their clients to get them in the fives because it's more affordable to be in the fives, and many people believe interest rates are going to come down in the future. So hopefully you got a little something from this podcast talking about interest rates. And that's the Real Estate Show with Pat Lopez. Be sure to follow the show on Facebook, Instagram, and subscribe. I have some great guests coming up. Tax season's coming up, so I have a CPA talking about taxes. And also leave a comment. Tell me some things that you like or you don't like, or some topics you'd like me to cover in the future. Remember, this show is everything real estate, no limits. Hope you enjoyed the show, and I'll see you.